Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 28th of November. I'm Daniel Lam, your host for the podcast. After our discussion yesterday on dollar CNH, let's continue to talk about our thoughts on other currencies. The main theme driving the US dollar is the market's repricing of the Fed's actions. Essentially, the market is still pricing in monetary easing, but in a shallower path. Trump's policies are pro-growth domestically, including fiscal stimulus and deregulation, which in turn is likely to reduce the downside risk to the US economy. Now, as we spoke about in yesterday's podcast, Trump's policies is detrimental to the growth to the rest of the world. So we assume more monetary easing in places like the euro area, which in turn contributes to US dollar strength. Now, the risk to the dollar strength scenario is that if tariff cause a hit to US growth as businesses and consumers pull back in the face of higher prices. Thus, overall the environment still lends support to the dollar, but how much of this has been priced in already? Is there still downside to euro dollar? Well, the euro dollar has dropped by roughly 6% since the beginning of October. The 2-year swap rate differentials have moved nearly 100 basis points in favor of the US dollar, with market pricing now implying a spread of around 200 basis points between FOMC and ECB terminal rates. Now, the euro area continues to be vulnerable to the spillover from tariffs and trade wars. The room for fiscal stimulus is somewhat limited in euro area countries, and the pressure will fall on the ECB to support growth with monetary easing. Technical indicators for euro dollar are still firmly to the downside. Hence, there's likely to be pressure on the pair in the very near term. Now, the story is somewhat different in Japan, the one major economy undergoing monetary tightening. The rise in US government treasury yield since the middle of September had led to the sharp rise in dollar-yen. However, the US 10-year government bond yield seemed to have peaked around the key 4.5% level, and this is starting to lead to the pullback in dollar-yen. Moreover, risk aversion may lead to renewed yen strength should the Trump tariff get more aggressive than expected. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.